Welcome everyone to another edition #askrobco. Hope you are all well. Hope you are enjoying the budget or have just watched the budget, got the property section just in time for us to talk about it, which is great news because we're pretty much hot off the press and live as we speak. James, you okay?
Yeah, very good. Thanks, Rob. How are you?
Really good, thanks. So James, let's go straight into that. Literally minutes ago, we heard the news from Chancellor. And what are the latest things for property, for the industry, for the economy that we're going to talk about today? And let's discuss how we see that they could affect our industry.
Yeah, sure. So in terms of property, as expected, there is a stamp duty. The stamp duty holiday freeze of the first £500,000. This has been extended by 3 months up to the end of June. So some positivity there in the market will allow some deals, obviously, to continue and to complete. There is also some further news on that, which wasn't necessarily anticipated. Slightly different bandings for the following 3 months after June on the first £250,000. We're going to have to bring you more on that, as Rishi Sunak has literally 10 minutes ago announced this. So we're just trying to establish the finer details of those those benefits for the economy. There's also been further news in the retail and hospitality sectors on the high street. We've got a 3-month business rate holiday for those businesses, which is absolutely massive for the high street, and will hopefully enable shops to reopen, new occupiers maybe to take up some of those vacant units on the high street, with a further 2/3 reduction for the remainder of the year. That's for business rates in the hospitality and retail industries. I think that's one of the biggest things coming out of the budget so far in terms of the property sector. We did comment on this last week. Well, obviously, in the previous budgets, these have been largely focused around the residential and construction sectors. Now I think the Chancellor, the Exchequer, is just trying to rejuvenate those other sectors of the property market and the built environment, Rob.
Okay, so stamp duty extension, that's the to the end of June. The banding changing from up to 250, the bottom band, for another 3 months, with further details required on that. And then they've proposed and come forward with their proposal of turning renters into buyers, operation buy. Let's discuss that, because I think that's the biggest thing from this budget. And we're talking about the largest budget since wartime, since the last budget, which was the largest budget since wartime because of COVID. What are the implications of that, or what's our understanding around that piece, which they already have stated that Lloyds, Barclays, NatWest, HSBC, Santander, and the 6th bank after that, which is Virgin Money, Clydesdale, have proposed that they will be joining. We're talking the 6 major banks in the country. So the only lender outside of those 6 that the government hasn't commented would be the Nationwide, which is a building society, not a bank. So talk us through that.
Yeah, Rob, this is absolutely massive news. It follows on from some of the changes we've seen to Help to Buy with this new government-backed 5% deposit mortgage. We understand that it could well be available to both first-time buyers and those also will be available to some current homeowners. We're not quite sure about that. There could be affordability criteria in there and some means testing. We're not sure. We're going to have to bring you some further details on that. But it follows on from the Prime Minister's speech in the November 2020, which his slogan was the generation rent, turning those into generation buy, and getting those who aren't on the property ladder yet, enabling them and facilitating them to buy their first home. And those properties which are going to be eligible for this new incentive of the 95% mortgage, 5% deposit are going to be on homes up to £600,000. So it's going to be extremely far-reaching in terms of the prospective buyers and first-time buyers, which are going to be eligible in facilitating them to possibly, in most cases, buy their first home, their first property.
Yeah, I mean, I do think this is huge news. We've repeatedly discussed this on the show over the months, stating clearly that we believe that there's going to be stimulus and the market is going to be incentivized. I've often said that it's something similar to the MRICS in the 80s, Margaret Thatcher's policy of getting that generation to buy instead of rent. And I believe this is going to be a major, major stimulus and driver of both the economy and property prices and the industry, broadly speaking. I think this is going to have major implications, and I think it's going to drive the market, positively going to drive the market, because ultimately with that kind of government-backed scheme of 95% only requiring a 5% deposit, and yes, we don't know the fine details on what the requirements are, so very broad at the moment, but the combined triple whammy of government-backed 95% mortgages, of the stamp duty holiday window being extended to the end of June, with the base level of stamp duty being extended by 3 months up to 250,000. If you want to buy a property, I mean, let's really understand this. If you want to buy a property and you've been dreaming of it or working for it the whole of your life, and there was ever the moment where you didn't have to pay the stamp duty, especially up until the 250, for an extended period, which is huge because that encompasses a large percentage of most deals across the entire country. And you've only got a small deposit and you need a 95% a good rate mainstream vanilla lend, now government backed. The window of opportunity now is going to be your greatest window. You are not going to get another opportunity with such stimulus and incentivization that you're going to get now. And the reality of that, depending on the fine details and the small print, which we obviously don't have because it's only been announced 15 minutes ago, could lead to a very strong performing market in the short term. The medium term is a different story. In the short term, this will drive the market. Now, on the back of all of that, the market is already strong. So as we look through our weekly data, and we're just going to touch on this, and then we can go back to what we see happening in the coming months, but it's all connected. When we look at handout 1 and this week's data, which brings us up to the 1st of March, our sales column, which is where I want to start, at 258, it has grown every week. I've been telling you for weeks, we are getting busier and busier. We're seeing more sales take place. We're doing more valuations. The timelines for the lenders to get the applications through and for the valuation process is being stretched in all areas, whether you're a challenger bank, whether you're doing investment banking, whether you're doing buy-to-lets, HMOs, prime, super prime, private banking, whether you're retail high street, all of the timelines are drifting. All of the chain has come under pressure in conveyancing, in legals, in land searches, in sanction, in mortgage offers, in the brokerage side, in the paperwork side, in the valuation side, in the agency side. Everything has been stretched. And that's because the volume is ramping up week by week by week by week. Next week, schools go back, March the 8th. Broadly speaking, the end of March, the pandemic lockdown pretty much ends. I appreciate and understand that April the 12th is the date where the high street reopens. I appreciate and understand that May the 17th is the date where restaurants can be sat in internally, and vacations and holidays and international travel will start. But the way everything is going at this moment in time, with March the 8th and March the 28th, I believe come the end of this month, broadly, lockdown will be finished. The ramping up of valuations that we're seeing off the back of this budget, March, April, May, June, July is going to be busier and busier and busier and busier. And the market will be extremely buoyant for the rest of the year off the back of this budget and off the back of those incentives. And the numbers that we're seeing across all areas in the industry, so I don't care whether you're a challenger, whether you're a retail high street, whether you're doing specialist boutique product or commercial or private banking, the reality is at this moment in time, it's getting busier and busier and busier. And what has happened today is only going to be a rocket to surge that to even greater demand and even greater lending from the banking perspective into the industry. James, further points on firstly the numbers and the data here, and then secondly the implications of the data that we've seen in the first 2 months of this year and how they're going to impact and move forward in the coming months on the back of the ending, please God, of the pandemic, the ending of lockdown, and the stimulus and the incentives that the government have now released today.
Thank you, Rob. So in this week's data, it's obviously been a record week in terms of sales, which is very positive news. I do feel that that is off the back of the very hot market that we saw at the end of Q4 2020, with those sales now completing. However, it's obviously bringing some positivity in the market now. New instructions are slightly down. It's obviously going to be constrained in the first 2 months of this year so far, with access to properties difficult in terms of photography, brochures, production of these viewings. So when the market reopens, I am expecting quite a rush of new instructions, which I think in turn will also create the demand and increased sentiment in the market, which is obviously a positive thing. What we're seeing so far, pricing seems to be withstanding the slightly lower levels of transactions than what we saw last year. This is going to be an interesting one to watch, but as the market reopens, that's going to be where all positivity is, and with the extension of the stamp duty freeze, as we've seen today, for 3 months, be interested to see whether there's many new deals which are agreed, which will in turn benefit from that, because 3 months is quite a narrow period to get from agreeing a sale through to exchange and ultimately completion to benefit from this stamp duty saving.
Yeah, I just want to reiterate for those latecomers and for clarity purposes, I want to reiterate again, the stamp duty holiday up to 500,000 has been extended from the end of March to the end of June. So that's what we were told and we were aware of. The new piece that's been added today is that there will be no stamp duty on any homes worth up to 250,000 for another 3 months post the end of June, which means till the end of September, and from October, the new levels of stamp duty of the 125,000 of the previous level, return. So no stamp duty till the end of June, no stamp duty for homes up until 250,000 till the end of September. So that's a 6-month period to which stamp duty levels, as we knew it pre-pandemic, return from October. 5% reduced VAT on hospitality and tourism sectors, business race holiday for retail, hospitality and the leisure industry extended to the end of June, and for the remaining 9 months of the fiscal year, they will be discounted by 2/3. And the 95% government-backed mortgages that have been supported by Lloyds, NatWest, HSBC, Barclays, Santander, and proposed Clydesdale Virgin, the 6 largest lenders in the UK as banks outside of Nationwide, who are a building society and not a bank. So as of today, March the, can't remember the date, 3rd, we are super busy. The market is very buoyant. There is a lot of expectancy with new properties coming on stream this month as lockdown ends and as the schools go back. Everything that the budget has done today suggests to me, and my view, purely looking on transactional volume, is we're going to get busier and busier and busier. Demand is going to uptick. And I just think if you can comprehend what the stamp duty window did to the market for us to have positively traded with record volumes not seen in 15 years in mortgage activity, if that happened off the back of just the stamp duty holiday that is now going to remain for the next 3 months and beyond for 250,000, so 6 months broadly, and with the 95% back mortgages, we are in for a record surge. There are just no two ways about it. There is going to be a surge of mortgage activity for at least the next 9 months, so the remainder of this year, and beyond into 2022, depending on how the economy and jobs recover from COVID, which is massively now supported by the government with the extension of furlough, and what are the fine details behind the 95% mortgages. Is there going to be barriers to entry? Is it going to be open to everyone? Is it going to be predominantly first-time buyers? We need to see the broad detail, the fine details behind that, and how long is that going to be in the market for? But what is going to be clear is between now and the end of the year, activity levels are going to return to where they were in 2020, and they're probably going to supersede that on the back of today's incentives. And I've been stressing for months that I believe this budget was going to be the one that gives to the property industry, because I believe that government see the way out of the current economic predicament through property, through mortgage lending backed by the major lenders in the country, and driving property and construction, home ownership and lending is their way out of this, along with supporting commercial businesses to return to which they believe that come the summer, June, July, August, the biggest 3 months or 3 of the biggest months of the year outside of Christmas for hospitality, they're going to see those big months return. Commercial lending will come back strongly as the jobs in those areas return. And I think we're going to have a really strong period as long as the government control COVID the way they're doing, as long as the country gets vaccinated, as long as there isn't a new strain of the virus. I think we're heading for a strong return. James, anything I've missed, anything you want to add, anything you want to share? We've got a great audience today. All of the major lenders in the country are with us. What are we saying to them on the back of this, and what will we be seeing in the coming weeks and months for the rest of the year on the back of today's budget?
Thank you, Rob. Well, I think definitely the news from today is going to create some more momentum in the market, and hopefully that's obviously going to align with the relinquishing of the lockdown. So together, I think those two things fused together will create a further bounce in the property market. We're already seeing signs on the ground of this, as we're bringing you every week, from ourselves, more sales, increased activity. We're certainly very busy. We're out on valuations every single day, and transactions are happening and are going through. So I think it's a little bit of wait and see with the market, but I think with with these measures, it is going to create certainly some enhanced sentiment.
Absolutely. The closing message I want for today is stick with us the next few months. I'm convinced that the data and the intel that we are sharing with you weekly is going to be your guide and path through this pandemic and through the changes in the industry. I'm convinced in the coming weeks we're going to see a surge, and the data is going to tell us which direction that is going. We're going to see huge surge residential. That's clear and obvious because of the new policies set out today. We're going to see a return to commercial activity as people return to the offices, the high street returns, hospitality, tourism, and all standard trades that have literally been locked down for a year are going to return. We're then going to see which areas of the industry and lending, you know, I know I've pushed HMO the whole year. It's the product of 2021 and 2020. It's where the investors are really plowing into. We're going to see which product is working and performing or outperforming the other products as we start to see the trends and develop, the trends develop off the back of all of this stimulus, all of this money going into the economy, and especially in finance, money, lending, mortgages, and ultimately property and the real estate. So thank you for joining last minute today. We've given you a perspective of how we see things. I'm convinced that the data we're going to share with you over the next 2 months is going to set out the remainder of the year in terms of where you should be protecting your risk and concerns, and where you should be lending, because that's where the demand is. And the one thing I can guarantee, and 100% guarantee to you now, is that the supply chain in all aspects, from lending, from banking, from sanctioning, from legals, from searches, from valuation, from agency, from the whole supply chain, we are not going to be able to cope with the volumes that we're going to be hit with in the coming months, which is a positive because there's going to be more demand than the supply that we can provide in the chain. And we're all going to have to work tremendously hard together to get through that. And obviously, we at MJ Group will support all of you the best we can to get you through that journey, because we're all going to be under immense pressure, immense timelines, and immense volume of business as a result of today. So thank you everyone for joining. Thank you for your input. James?
Just got some closing property news to bring everyone. In terms of activity in the market, we know that London estate agent chain Foxtons has acquired Douglas & Gordon for a purchase price of £14.3 million. This aligns with Foxtons' strategy of acquiring high-quality businesses with strong lettings books. Douglas & Gordon, they've got around 200 staff across 19 branches, so those will be rebranding, we assume, in the coming months, and will form part of the Foxtons franchise. Furthermore, down at Battersea Power Station, we understand that the anchor tenants there, in terms of the commercial, Apple, have been handed over their 500,000 square feet of office space in the power station, which they'll start to fit out as their new UK campus, which will obviously create more people down there, continue to rejuvenate the area, and maybe boost some of those retail offerings, restaurants, cafes, convenience stores, which they've got there in almost a new village, really. So that's some property news for you in the past week.
I think that's great breaking news on the back of the Connell's Countrywide transaction the week before. I think they're very smart and savvy moves at this time, knowing the residential market is going to strongly perform now, I think those transactions could turn out to be very positive ones. And the battery space, most of you know we're specialists in the area. We do a lot of the new builds there. We will bring you battery power update in the coming weeks, and we will have a show around that. I know there's so much interest there. We will bring that to you. Thanks for that, James. Thanks for all your input. Thanks for everyone joining at such short notice for this budget special live. Keep joining us on all the platforms. Keep watching, keep asking the questions, and we will keep giving you the content, the intel, and the market knowledge that we have live on the ground every week. Everyone take care, be healthy, be well, and we will see you same time, same place next week. Thank you very much.
Thanks very much, everyone.